This is part 2 of the Kumo Breakout. If you missed the first part, click here. If you're anything like me, you want to know, is this strategy actually profitable and under what conditions? John recently posted a comment asking if there's a strategy with a win rate of 50% that also has a profit to loss of 2 to 1. To get an unbiased answer, I went all the way back to 2006, which is as far back as TradingView would show me. I took every Kumo breakout on the daily and 4-hour charts for all 7 major forex pairs. When all was said and done, I had right at 600 trades in my spreadsheet. In this video, I'm going to start sharing my results with you. But before we do, let's take another look at his question and see if it's the right one to ask. You may have seen my super trend video. I backtested someone else's strategy and found it was profitable right out of the box. But I didn't stop there. I put my own spin on it and made it 3 times better. Coming back to his desire, there's no doubt 2 to 1 with a 50% win rate would be profitable. But can we do better? Here we see we have a 2 to 1 and win 50% of the time. On average, we win 0.5R in over 300 trades. We'd be up 150R. But that's not the only way to do it. What if we only win 40% but have a 2.75 to 1? We'd still make 0.5R and 150R over 300 trades. Or on the other side of the coin, we go from winning 40 to 50% of our trades up to 75%. Now we only need a 1 to 1 to make the same 0.5R per trade and 150R over 300 trades. What if we're still able to win at 40% but bump our reward up to 3 to 1? Now we make 180R instead of only 150. We're not trying to win the most trades. Our goal should really be to maximize the total R we win. That's what we put in our bank account. That all sounds good in theory, but where you set your stop loss actually affects your bottom line. Here we want to go long and we know we want a 2 to 1 ratio. Let's say we have a $1,000 account and we're risking 2%. These 2 trades may look different, but in terms of R to R, they're exactly the same. In both cases, we'll lose $20 or win $40. Playing the next candle, we see a wick down. This took us out for the full loss on the left, but on the right, we're still safe. A couple candles later, we see we hit our full take profit on the right. On the left, our account is now $980, but on the right, we're up to $1,040, which is a 6.1% difference just from this one trade. It's not enough to say you want a 2 to 1. You have to test and optimize where your stop is in the first place. With all that being said, I'm not going to assume 2 to 1 is the best ratio for the Kumo breakout. The other issue is how to compare results across different pairs in different time frames. Not to mention some pairs have smaller ranges, while others are more volatile. We need a way to analyze our numbers in an apples to apples way. For example, on the top is a 4-hour chart and on the bottom is a daily. Here we have what looks to be an average size move of about 200 pips. On the daily chart, what looks to be the same relative distance is about 900 pips. The way to standardize results across the board is to use the average true range indicator. Scrolling across, we see on average we expect AUD US dollar to move about 30 pips in a 4-hour time frame. On the bottom, it's not unusual to see USD CHF move 75 to 125 pips in a day. When we set our stop loss, we're going to use ATR as the baseline. Once again, we shouldn't assume a stop loss of 1 is the optimal distance. I decided to test 0.5 up to 2.5 times the ATR. In the same way, we shouldn't assume a multiple of 2 for profit is best. I want to see what happens when our take profit is anywhere from 0.5 to 5 times our stop loss. As I mentioned before, when someone wants a 2 to 1, there are actually 9 ways to get there. We have 9 choices for the stop loss and 19 for take profit. So for each individual valid entry, I tested 171 different combinations to see which would give the most profit. Each dot represents the 600 trades for a specific combination of stop loss and take profit. On the left is how much we would have made. So for example, if we set our stop loss to 0.75 ATR and take profit of 0.5, we would have lost 227 R over the sample. Out of everything, there were only 2 combinations that I won't say were marginally profitable. They were break even at best, if we're being honest. A stop of 1 ATR and a take profit of 1 was plus 3R. The best result here was a stop of 2 ATR and a target of only 0.5. These results are obviously horrible, so it's better we know this now than wasting our time and money trading it in real life. Let's think of another way to tweak the strategy that might have better results. So we're going to have 2 new rules. We're going to take half our position off at 1 ATR. When we take our profit at 1 ATR, we're also going to move our stop loss to break even. So here we want to take this short. We see an ATR of 184. We'll give it a little more room at 190 and then we'll set our take profit at 2 to 1, 380. First candle, we're in profit. It's moved 59 or 5.9 pips. It hasn't moved far enough, so there's nothing to do. We're 15 pips in profit. Our stop loss is 19 pips, so we're almost there. Here we're closing 22 pips in profit. This is past the 19, so we would take half our position off. So now we've taken half our position off. We're either gonna take the rest at 2 to 1, or if price moves up, we're gonna get out at break even. We see price crossed and we hit our full take profit of 2 to 1. We split our trade into 2 positions. We took off half our position at 1 ATR. The second position was at 2 to 1. So on the first position, we made 0.5 R, and the second we made plus 1 R. Normally at 2 to 1, we'd obviously make 2 R. In this case, our profit is 1.5 R. So let's go through that trade again, except this time we're shooting for 2.5 to 1. So once again, we take off half our position. This time we get taken out at break even before we hit our take profit. So in this case, we make a total profit of 0.5 R. As I mentioned, the all or nothing, we would have lost a full 1 R. So as you can imagine, these 1.5 Rs are going to add up over time, and hopefully we'll have better results. So with this one simple change, look how many strategies are now profitable. And we see the strategy works on the daily as well as the 4-hour. Now, if you recall, our options for drawdown were anywhere from 0.5 ATR all the way up to 2.5 times the ATR. I've sorted the results by most profitable. Let's first look at drawdown. We've got a drawdown of 1, 1.75, 2, 2.25, 2.5. One thing you'll notice in the top results, we don't see any of the smaller drawdowns, 0.5, 0.75. It's not till we scroll all the way down to the bottom, we see 0.75 ATR showing up. And you'll notice 0.5 isn't an option either for the combined or just the 4-hour time frame. Now looking at just the daily results, we start to see a few of the 0.5s show up. Even still, we had to scroll down to find them. They're nowhere in the top results. So in general, on the 4-hour time frame, we want our stop loss to be anywhere from 1.75 to 2.5 times the ATR. Moving over to the daily time frame, we can actually have a smaller relative stop loss. We want it anywhere from 1 to 1.75 times the ATR. Another big difference between the two time frames is our profit target. On the 4-hour time frame, we're not looking for home runs. We want to get in and we want to get out. Conventional wisdom is to have a 2 to 1 or 3 to 1 take profit, but that's not the case on the 4-hour. On the 4-hour, we want an R to R right around 1, anywhere from 0.8 to 1.3. The daily targets are more in line with the traditional 1.5 to 1, 2 to 1, and even some 3 and 4 to 1s thrown in there. We're able to have a higher R to R as a function of the relatively lower stop loss. If you look at these two options, they have exactly the same profit, but they go about it in different ways like we talked about before. The top one allows more drawdown and takes profit quicker. The bottom one will have more losses, but this will be balanced out by the larger wins. Depending on your personality and trading style, you may prefer one over the other. A lot of my assumptions were proven wrong, and that goes to show why it's so important to actually backtest, instead of just going with someone's opinion or your gut feeling. One thing we know is how important it is to lock in profit. Move your stop loss to break even at 1 ATR. There may be times where the trade goes in your direction. You would have made more money by taking the full profit. But in virtually all scenarios, this is a long-term losing strategy. The method you just learned is profitable on the 4-hour and the daily, but they need slightly different approaches. Because the 4-hour chart is more noise than the daily, we can expect the trade to stutter and have more drawdown. This is why we have a larger stop loss on the 4-hour compared to the daily. On the daily chart, we can get away with having a stop of 1 to 1.75 the ATR. But on the 4-hour, we want a minimum of 1.75 going up to 2.5. Once we have our stop loss set, we can now focus on our target. On the 4-hour, we're shooting for around a 1 to 1, but on the daily, we can extend it to 2.5, 3.5, and beyond. It's time for a pop quiz. Make sure you understand. So here we're on the 4-hour time frame, we get a Kumo breakout. ATR is about 300. Our stop is slightly below. It's 320, and we set a take profit of 3 to 1. We were right and we hit our full take profit. We made 3R. Was this a good trade? It's not about if this one trade made money or not. You have to ask yourself how it would do if you took the same trade over and over again. You would have for sure lost money over the long run if you approached it like this. The number one rule for the Kumo breakout, it's never all or nothing. The second problem is on the 4-hour time frame, our stop loss has to be 1.75 to 2.5 times the ATR. Here we only set it at just past 1 ATR. On the spreadsheet, there were a few cases where 3 to 1 was profitable, but the sweet spot is really 0.8 to 1.1. So here's another trade. I want you to tell me how much profit we should have made. Step 1 is, what is the current ATR? We're at 281. We're going to use a 1.7x multiplier. How big should the stop loss be? Stop loss is going to be a little over 492 or 49 pips. Where are we going to move the stop to break even? At 1 ATR, 281 or 28 pips. So here's 281 right here. That's where we're going break even. So our stop loss is set. Now we want to drag this up. We're going to do a 1.1 on this. We almost hit the 1 ATR, not quite. So we're risking the full stop loss. So when we hit that line, we would take half our position off and move the stop loss up to break even. And we got taken out. We took half the position off when we got to 1 ATR for a profit of 0.6. We let the trade run and exited at break even on the second half. What was the total profit? Total profit would be plus 0.3R, 0.6 times half plus 0 times half. We have our next trade set up. ATR is 188 and our stop is at 334. We have our order set to take half profit at 18.8 pips. How much profit would we make on this trade? We see we went into profit at one point, but not far enough to trigger our take profit at the yellow line, or enough to move our stop to break even. We'd lose the full 1R. But don't be surprised, the Kumo breakout isn't the holy grail. In the long run, you'll make money, but along the way, you'll have many losses. In previous examples, we set our stop to 1.75 of the ATR. How big will the stop loss be if we use 2 ATR now? Normally, you'd see the ATR of 291 and multiply by 2, but even before that, don't forget to verify it's actually a valid Kumo breakout. We have a problem here. When the Kumo changes, there's a blank gap before it's the real color. It's not until this candle that we see the Kumo actually turn red. Now that the future Kumo is red, we still want to set our stop loss to 2x the ATR. How big will it be? Don't forget from the previous video, a Kumo breakout happens on the first candle when it closes below. This happened last candle, but it wasn't a valid setup. To have a valid setup, price has to go back into the cloud. When it closes below, we can look for a short signal, or if it crosses and closes above, we can look for a long signal. We see price running away from us to the tune of 800 pips. None of this would have been captured by the Kumo breakout. It can be frustrating, but on the bright side, Ichimoku offers other ways besides a Kumo breakout to get into this trade. In a future video, I'll show you how all these other entry signals work. We've gone over a lot of Ichimoku in the last few videos. Most entries require 5 things to line up. A valid Kumo breakout needs all 5 at the same time it crosses and closes above or below the cloud. After 600 trades, it's pretty clear the only way a fixed profit target works for Kumo breakout is when you take partial profit at 1 ATR, move up your stop loss. As we saw in the spreadsheet, the 4-hour time frame has larger stops and smaller take profits compared to the daily. It's great there's a fixed profit target strategy that works with Ichimoku, but at the heart, Ichimoku is a trend following system. It's not designed to cut trades short at 1-to-1 or 2-to-1. The real power of the Kumo breakout is when we use Tenkan-sen or Kijun-sen to trail the breakout. That's coming in a future video, so make sure to subscribe. In the meantime, get caught up on my previous Ichimoku videos, or I'd highly recommend you check out my essential playlist of risk management and psychology. Thanks, and I'll talk to you soon.